What's up guys, welcome back to the channel. Today we're talking about Wyckoff. Right, so the Wyckoff Trading Course. I've gotten a lot of questions about the Wyckoff Method. Today you're getting a free course about the Wyckoff Method. What I think is important, how to use it, how to make money with it. That's what I'm going to discuss today. It's going to be a bit of a longer video. Take notes. And if you have questions afterwards, comment down below and I will answer those. So let's get started. Today I'm going to talk about, first of all, realistic expectations. What's the Wyckoff Method? Market cycles, accumulation distribution, entries and statistics, and conclusion. Realistic expectations. Lately, a lot of people have been using the Wyckoff Method. I've been using this for almost 6 years right now, but lately, a lot of people start using it and they show you like it's the holy grail. This is it. This is how you make money trading. There are thousands of ways to make money with trading, and that's something to realize. This is just a trading method, and if it fits with you, you can make money with it. But if it's too complex or if it doesn't fit with you, then it's okay. There are multiple ways to make money in the market. So let's get that out of the way first. It's not a holy grail. Next to that, you're not getting these high risk to reward ratios. A lot of people show on social media, oh, I just made a 1 to 200 risk to reward trade. That's ridiculous. Those types of opportunities, maybe sometimes once per year, they are there. But it's really hard to build a career upon those trades because there's a lot of luck involved in aiming for such high risk reward ratios. Your strike rate is very low if you aim for a big R. And on top of that, the impact of slippage, especially if your trade is on a lower time frame, can be very, very big. So I trade the Wyckoff Method and I only get a 1 to 1.3 R on average, but my win rate is 65 to 70%. That's why I make money. Now you can get a bigger risk to reward ratio, but from what I know, from what professionals often average in terms of risk reward, is a 1 to 2, 1 to 3 R on average, not 1 to 10, not 1 to 50. That's all complete bullshit designed to sell a course to you. So be very skeptical when you see this. I'm not going to teach you how to trade like that because it's ridiculous. Next to that, you don't get a Lamborghini within a week. Shocker, you don't. It's hard work, guys. Even if you get a right method that fits with you, it is still hard work. It still takes time to become a profitable trader. You still have to backtest a lot. So please don't think you will get rich within 6 months if you learn this method, because it's not going to happen. Now, with that out of the way, let's actually dive into the Wyckoff Method. The Wyckoff Method is a study of supply and demand. The market's transaction because of imbalances in supply and demand. That's what drives prices up. That's what drives prices down. If, let's say, you sell an apple and there are only 10 of those in the world, then the supply is really, really low. You have something rare. If then the demand also increases, your prices of your apple will go like that. However, if these two are in balance, then you get stable prices. If for some reason an asset gets more demand, so more people want that asset, and the supply stays relatively the same, then you get an increase in pricing. The Wyckoff Method studies supply and demand in a certain asset, currency pair, whatever you're trading. So it really is a study of supply and demand. And the goal is to identify what's happening to the supply and demand. What are bigger players doing? Are they absorbing certain supply or certain demand? Are there clues that they leave about the types of positions they got on? Those are the things that you do with the Wyckoff Method. You're not picking bottoms, or I don't know what people say these days, but this is what you're doing if you use the Wyckoff Method. The goal is to join the bigger player. because you have to realize this. If a bigger player, and I'm talking about a big player in the market, wants to buy, let's say he wants to buy at a price of 110. He wants to go long with 10,000 lots, but at this price, only 5,000 lots are selling to him. That means only half of his order gets filled. The other half gets filled at a higher price. And maybe if there are only 2K sellers, then it will be filled at an even higher price until the order is filled. That's what happens if they just buy. So what bigger players often do is they scale in their position. Over time, they build a position around the same price level to prevent this from happening. Also, they like to go long at areas where there is a lot of selling, because if they want to buy, there has to be a lot of selling. So for example, if you have a support area and it breaks and then immediately price shoots up, this is a good indication of, okay, there is a lot of selling here, but someone absorbed all this selling and now price is shooting up. This is what you're doing when you're using the Wyckoff method. So if we dive deeper into that topic, the market consists of cycles and it's fueled by supply and demand. For whatever reason, it changes, and that's when there are different cycles. Usually, if you look at a market, it is something like this. This is an average market cycle. What you can notice is that big trend changes rarely happen without some form of a range and some form of a false breakout, as you can see. This is true for almost every asset you trade. You rarely get just market goes down and boom, it goes up, new highs. That's often not the case. It can happen, but usually before you get a sustained uptrend, you get these trading ranges. And that's essentially, in terms of the Wyckoff method, that's essentially what you are looking for when you are trading. So this is what we call an accumulation range. This is where a bigger player accumulates a position in a certain asset in order to go long. This is where he scales in his order. This is where he absorbs the available selling liquidity to go long. During these ranges that you have during a trend, this is what we call reaccumulation. During those ranges, sometimes these bigger players scale out some of the profits, and sometimes they just buy more and they scale in again. And that's when you get these ranges and all of a sudden a breakout. This is what happens during an uptrend. With a downtrend, you get your distribution range, which is here. Same thing happens. Selling is being done in this area. Scaling in is being done. You often get a false break of the highs here, where if there is a lot of buying, he can sell at a great price without slippage, without causing selling at a lower price. Then the market goes down and you again get these types of ranges, which are redistribution ranges. This is essentially how a market moves. There are, of course, variations to this, but this is essentially what happens. And it's all driven by supply and demand. A bigger player, for whatever reason, wants to be long in this area. He wants to absorb the supply and build a long position. You don't always need to know the reasoning behind it to trade this successfully, but these are the market cycles. Now, if we dive a bit deeper into accumulation distribution, like I said, there is building of positions. There is scaling in. There is absorption of liquidity. These are the things you see, because you have to think about it like this. When you get a trading range, supply and demand are balanced. During those ranges, you get people selling and buying. Where do the stops go? Often they go above the range, below the range. This is where you will get buy stops and sell stops accumulating. Then what's interesting is if someone buys in this range, if someone buys here and the stop goes below here, the stop loss is a sell order. Why? Because if someone buys at this price and price goes down, so it goes down to that area, to the stop loss, they sell the order back to the markets at a lower price, and that's what's causing you the loss on a buy trade. You also get people selling a breakout when this level breaks. They think, okay, it's going to tank lower, price goes down, we're going to sell. So essentially you get a lot of selling here. If then this happens, then you know, okay, despite all the probable selling in this area, the market just shoots up. It just shoots up. And that's very, very interesting stuff. And that's what we call absorption of liquidity. So during the range, you get scaling in, building a position, and then this is what we call a spring, a liquidity grab, a false breakout, whatever you want to call it. And that's really important, this area, because this tells you if a bigger player is in the markets, yes or no. This tells you, okay, there is a lot of selling here. Can we go down? In this case, no. That tells you a big, big story. Same thing with distribution, but it's the other way around. So you have your trading range, you have your false break of the highs, and then a move down. What I always want to see is different behavior on both sides of the range. So for example, if you get a false breakout of the highs, usually what happens here is quick and aggressive. You don't want to just price go up, stay here, retest, make a new small time frame high. That's not what you want to see. You want to see violence, speed, aggressiveness in these areas, because essentially it's just a quick absorption of liquidity and then price goes down again. So that's what you want to look for. When this happens, you want to look for what happens at the low end of the range. Same here. You want to look at what happens here, because in these areas, you also have liquidity resting and you want to see different behavior there. You want to see acceptance despite of all the buying in this area. I'm sorry, despite of all the selling. So there's a lot of selling here, but you don't want to see that the selling being absorbed. You want to see acceptance of price when you get that breakout. You don't want to see a V-shaped return back into the range. That's really, really important when you look for accumulation and distribution. So let's give you some chart examples about what to expect. Here we have the euro dollar chart. And this is a textbook accumulation range. You get your low of the range here. You get a test of the low of the range. You get another test of the low of the range. So essentially a triple bottom in this area. This is your high of the range. What do we see here? Price dips into the low, immediately shoots up, and look at these two candles. Big aggressive speed to the upside. We break this level, we stay above it, and then we go up again. This really, really indicates absorption of liquidity. Look at the other side. We break the high of the range, so you can expect to be a lot of buying here, but it doesn't get absorbed. We stay above the range. We get acceptance, completely different behavior than from what we've seen here. That's what you want to look out for. And then you get your reaccumulation range. You get a range forming. Again, we sweep the lows. Then we break the highs. Look at this. Completely different behavior. As soon as we take out the low, we shoot up. As soon as we take out the high of the range, we stay there. That's essentially what you want to be looking for. This is a clear accumulation range. Here we have a distribution range. It's not the best textbook example, but it definitely is one. The best one would be if this high got swept, but that wasn't the case. However, look at these equal highs here. That's the high of the range. This is the low of the range. As soon as we take out the highs, we fall down immediately. Look at this candle. This tells you a lot about what's happening. Look at what happens when we break the other side of the range. We don't get a quick rejection. We stay here. We stay here. We accept below the level, then we retest and we go down. Completely different than what we've seen here. That's what you want to look out for, guys. The order flow around the boundaries of the ranges. So now I want to talk about entries and statistics. So let's go back to the charts. In terms of entries, long entries in accumulation, in my opinion, there are only two ways to go about this. You don't enter during this entire area. You enter after the false breakout. And then there are two options. you either enter on the momentum directly after the spring or some retest after the spring, or what I do is I wait for acceptance on the other side of the range. This is where I enter. Those are, in my opinion, the two options. So here in the green area, or let's make it blue in this area. Of course, you can wait, like I buy the breakout, you can wait for a retest and then go up in this area as well. But these are the two areas. Now, in terms of statistics, I have backtested so much pairs, so much setups, so much rules. And what I can tell you, this is what you have to investigate for yourself. But from my testing, hundreds of trades, years and years of data, I can tell you that if you enter in this area, you have the highest win rate. If you enter in this area, your win rate is lower, but your risk reward is higher. That's essentially the difference. You determine what you like. I like a higher win rate, so I enter here. It also gives me more confirmation because in this area, let's say you enter here where the arrow is. This looks like a Picasso drawing, I know, but let's keep focused. If you enter in this area, you can still have a false breakout of the high of the range and then continue down. That's not the case if you get acceptance above the range in this area. So this is more confirmation. That's why your strike rate is higher if you trade like that. This gives you a better risk reward because let's say you enter at this line, your stop is going below the spring. And let's say this is your target. That's a big risk reward. But if you enter here, you have around a 1-to-1, but your strike rate is way higher. Again, there are ways to improve this. So those are things you want to think about. How can you enter this? If I quickly draw on a screen what I do, accumulation, false break, entry for me. What you can do is buy a retest. Those are two things you can do. And then of course, enter after the spring, like I said, but these are, in my opinion, the safest option, either buying the breakout after acceptance or buying a retest after acceptance, not trying to pick the bottom of the spring. Essentially what I look for in my trading and what's the easy money is buying here and taking profits there. Because if you go back to what I said about market cycles, the market then does this often, and then it goes here, and then it forms a distribution range and goes down. The easy money is in this area. This is where the easy money is. But most people focus on getting an entry here, and you very often buy and then the market continues down because you're trying to pick a bottom. But why not enter later in an area with a lot of confirmation and simply hop on the momentum to ride another wave up, and then you're getting out. You don't take the top, you just get out and then you wait for a new setup. And then let's say here we have our distribution range and I sell here and I just ride the momentum down and I step out of the trade. And I don't care if it goes down lower. I just take the easy parts of the market. That's where I make my profits. There's no need to pick the bottom, to pick the top. That's not needed to make money in trading. So that's something to think about as well. The highest win rate is accomplished if you enter in this area. The highest risk reward is entered here. It's up to you. Do your research, backtest for yourself, see what you like. But this is how I play this. So to conclude, guys, the Wyckoff method is an effective trading method if you understand it and if you backtest it correctly and have realistic expectations. It's not what you see on the internet these days. On average, my risk reward is 1 to 1.2 or 1.3. My win rate is 65%. This is how I make my money. I know a lot of professionals that have a 45% win rate and a risk reward of 1 to 2, sometimes 1 to 3. That's it, not 1 to 100. don't aim for that, because it really harms your performance, guys. So hopefully you like this video. If you have questions, comment down below. If you want to know more about me and my company, go to my website, cdfxtrading.com. Lots of free stuff out there on my website. So yeah, check it out, guys. Subscribe. See you next time.